Hey, hi everyone. Perhaps we give some other people like perhaps maybe another 2 to 3 minutes time before we start. Yep, thanks.
No, no, because when I try to use computer, I cannot enter.
Okay, so yep. Hi, good afternoon, everyone. Thanks for taking the time today to join our credit webinar titled Chasing Yields with Fixed Income Instruments. So today we have with us our Phillips Fixed Income Desk, as well as myself, who will be conducting this webinar. So as always, just a disclaimer that this sharing session would just be for educational purposes and not to be treated as financial advice. So advisors and clients are supposed to do their own due diligence before making an investment decision. Yep. So, okay, let me quickly run through briefly on today's agenda. So first, we'll be starting off with the new issuance bond volume in Singapore. Then we'll be sharing a bit more on why do we look at US interest rates whenever bonds are being discussed. Then followed by what is the current bond yield environment and what is likely to happen moving forward. Afterwards, we'll be throwing in a few bond ideas to perhaps spur some interest before concluding this session with Q&A. So, okay, without further ado, let's look at the bond volume for new issuance in Singapore. So, year to date, there were 30 Singapore-denominated corporate bonds with issuer size greater than 100 million were being issued. This brings the total amount that was raised from these bonds issuance to approximately 9.2 billion worth. However, of these 30 new issuance, 20 of them were issued in the first quarter this year, while the remaining 10 were issued in the second quarter. So the slowdown for the new issuance in the second quarter was most probably affected by the banking turmoil, which happened during the March periods, which have spooked the market, therefore causing new issuance to shift to a lower gear. But despite us being in a high interest environment right now, there was still new issuance coming in. Thus, this shows that the issuers still have the bandwidth to issue bonds in order to meet their funding requirements. Okay, so I mean, some of you might be wondering why do people usually discuss about where will the US interest rate be trending before making any bonds investment? And furthermore, I mean, right now we are living in Singapore. For those who are viewing in Singapore, why do we discuss about US interest rates? So okay, I apologize if this graph is a little bit messy, But basically, if you were to look at this chart here, where the red line is the federal fund rate, or also known as the US interest rate, while the other colors represent our Singapore government securities. So it shows that when interest rates in the US moves in a certain direction, although not entirely the same magnitude, but Singapore bond yields tend to move in tandem. Hence, this portrays some sort of correlations between the US interest rate and our local bonds. Also, there's also a saying whereby where America sneeze, the world catches a cold as well. So I believe many of us would have already known this, but for those who are newer to fixed income as an asset class, particularly bonds, bond prices and interest rates are inversely related. But why is this so? Well, because bonds pay a fixed interest rate, which is also known as a coupon rate. Therefore, when interest rate climbs, investors would tend to demand a higher yield on their investment to compensate for the increased risk that they are taking. Hence, this makes older bonds, which pays a fixed interest rate, less attractive to investors. As a result, the prices of the older bonds will tend to dip from there. All right. So, now since we have established how US interest rates direction will give us an indication of bond yield, let's shift our focus to the current interest rate situation in the US. So, for those who may have missed out on the latest FOMC meeting that happened on the 14th of June, earlier this month, the federal fund rate was held steady for this meeting at a range of 5 to 5.25%. This was because the committee believes that the certain lags from the previous monetary policies and the potential headwinds from the credit tightening due to the banking spiral that occurred in the first quarter have yet to be felt. So, this is the first rate pause that we have experienced after 10 consecutive hikes. We have started back in March last year, but the pause was in line with market expectation. So how would interest rate move going forward? In terms of guidance during the FOMC meeting, hawkish sentiments was shared by Chairman Powell, as he mentioned that the committee participants viewed it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. So, if you were to shift your focus to the left of the screen, you'll be able to see the dot plot graph that was provided in this meeting. So do note that dot plot graph is only available every quarter of the year. So a dot plot graph is a chart that summarizes the FOMC's outlook for the federal funds rate. So in this chart, out of 18, nine of the officials are expecting rates to be above the range of 5.5 to 5.75% in the year 2023. While only 3 of them indicates it to move even higher. And according to the Summary of Economics Projection, or SEP in short, the terminal projected rate for this year has been bumped up to 5.6% from 5.1% previously. So, this further supplements to the guidance that we should be facing at least an additional 50 basis point hike this year. In order to reach this projected rate that was stated in the SEP. And we are also able to anticipate perhaps another 100 basis point cut in the following year, because in the SEP, they stated that in 2024, projected rate should taper down to roughly around 4.6%. Yep. And although recent inflationary data points such as the PCE and CPI index that the Federal Reserve watches closely have showed signs of moderation since June last year back. So when total and core PCE was rising approximately 7% and 5% year on year, the latest results for the total and core PCE that was released in April rose by 4.4 and 4.7% year on year. Meanwhile, the US May's core CPI rose by 5.3% year on year. This shows that the inflationary pressures in the US still remain sticky and it's also still well above the federal target range of 2%. Yep. So, I mean, what's the current bond yield environment and what we should be expecting moving forward? I mean, with the FOMC indicating that US interests will still have approximately 50 basis point more to climb before reaching their revised target range of 5.6%. I mean, we should expect bond yields to trend slightly higher till the end of this year. So this is the Fed Fund future curve, which shows what the market are pricing in for future rate hikes or cuts. So despite, I mean, the market being in line with what the FOMC committee have anticipated in the second half of the year, they are also pricing in for potential rate cuts in this diagram to come in roughly around December's meeting. So, I mean, although market are pricing in potential rate cuts in December, however, I believe that Jerome Powell have mentioned quite a few times in his meeting, he stated that rate cuts will be unlikely this year. But the golden question is, will US terminal rate trend even higher than the anticipated 5.6%? Well, personally, I mean, considering the fact that the committee have stated that the delay effects from the previous tightening has yet to be fully felt, and also despite inflationary pointers are not trending down as quickly, it does reflect signs that economy is indeed slowing down. Hence, for terminal rate to be bumped up even higher will be unlikely. However, if inflation were to surge again, then additional actions definitely will be taken by the Federal Reserve. So this is a chart for our 6 months Treasury bills. And as mentioned previously, as rates continue to creep up slightly, this is also seen in our recent Treasury bills auction, with the most recent auction giving a cutoff yield of 3.89%, back from 3.65% in March and also 3.84% in the previous fortnightly window of this month. Hence, I mean, given the indication of potential rate to increase even further this year, the possibility of the cutoff yield to trend even higher in the next window will be plausible. And for the next window, for our 6 months Treasury bills, will be open today. All right. Okay, so right now I'll be sharing on some of our bond ideas for this seminar. And the first bond that we'll be sharing would be OUE Limited, 3.5%. This is a senior unsecured bond with a maturity date of 21st September 2026. I mean, this gives approximately around 3.3 years left to maturity, with an indicative price of 94.4, which translates to an indicative yield of 5.4%. So, I mean, benchmarking it against our Singapore government securities, which is a 2.375%, which will mature in 1st June 2025. It gives off a yield spread of approximately 203.72 basis point. So, I mean, for OUE Limited, the relaxation of COVID policies and the complete reopening of their Hilton Singapore Orchard, which is along the Orchard's main shopping belt, have created a revenue to increase by 63.3% year-on-year. So within their revenue, their hospitality division reported a 147.7% surge in revenue to 142.7 million from 57 million previously. So, I mean, this figure, it's likely to be boosted with the global traveling rebounding in 2023. And also for OUE, there were higher contributions that were coming from its Crown Plaza Changi Airport due to the resumption of their MICE event. So MICE events are such as like their big scale meetings or exhibition or conventions. So I mean, in terms of their liquidity, although I mean OUE's cash position might be a little tight, which with its cash position standing at 362 million in FY 2022, its short-term borrowing amount to 578 million. I know this might be a little bit daunting, but hence, I mean, because they are unable to pay up using their cash, OUE will be likely to rely on their refinancing to pay off its short-term obligation. But I mean, although OUE is likely to face limitation in being able to utilize their cash freely, I mean, considering its thin cash flows from operations and their debt repayment obligations, nonetheless, given that this bond issuance is relatively small at a size of 200 million, we do not think that this would translate into a problem for OUE in terms of their refinancing, as from now to 2026, there's roughly around 3 more years. So there is rather an ample time for the policies rate to stabilize then, because for Federal Reserve, like I mentioned earlier, I think for the Fed fund rate, they were targeting to go back to 2% after 2025. So when this is 2026, that will be maturing in 2026, rates would somewhat be stabilized by then. So in terms of its credit profile, it is likely to stay decent in the short term, especially when the hospitality segment is expected to continue outperforming in these recent years. And with this outperformance, this will provide the much needed cash flow for OUE Limited. Yep. So for next counter would be hotel properties. So this, oh, sorry. Hold on. Yep. So for hotel properties, sorry. So for sorry, let me shift this down. Yep. So for hotel properties, this would be a 5.25%. This is a senior unsecured bond as well, with a maturity date of 9th of March 2028. So I mean, this bond comes with approximately 4.9 years to maturity, with an indicative pricing of 101.3, which translates to a yield of roughly around 4.93%. So benchmarking it against our Singapore government securities, 2.625%, that will be maturing on 1st of May 2028. The yield spread generated would be 187.24 basis points. So for hotel properties, there is a stronger performance that was recorded by the group's hotel and resort due to the reopening of the country borders. So for hotel properties, their revenue has rebounded by 52.7% year-on-year, and their cash flow has also improved from cash flow from operations, has improved from 56.6 million in FY 2021 to 147.9 million in FY 2022. And back in December last year, they have also stated that they will be disposing their 7 units in Ming's Arcade for approximately 61 million. So this 61 million will be added into their cash flow, and this will further boost their liquidity for hotel properties. So some of the alternatives bond that hotel properties also do provide are hotel properties. The first example will be hotel properties 3.75, which is also a senior unsecured bond that will be maturing on 31st May 2028. So the indicative pricing for this bond is at 94.688, which translate to a yield of 4.98%. So, okay, so you take this 3.75% compared to this 5.25% that I've mentioned earlier. Although this 3.75% is giving a slightly higher yield of 4.98 as compared to 4.93. However, personally, I would go for this 5.25%, although I'll be earning slightly perhaps a yield that is lower by 5 basis points. However, because of the earlier maturity date of roughly around 2 months, personally, I'll go for a shorter tenor, in other words. However, on the second bond, which is hotel properties, 3.8%, this is also a senior unsecured bond that will be maturing on the 2nd of June, 2025. This would be for investors that has a shorter time horizon and probably would like a short-term investment. So the indicative pricing for this bond is 99.145, which translates to a yield of roughly around 4.26%. Yep. So the last counter that we'll be sharing today would be HSBC 4.5%. This is a senior unsecured bond that will be maturing on the 7th of June, 2029. So as you can see in the middle, in between 4.5% and senior, there's a 6 NC5. So for some of you guys who don't know what does this mean, the 6 stands for the year that the bond will be maturing from the issuance date itself, and NC stands for non-callable. So 6 NC5 stands for 6 years to maturity, and this bond will be non-callable after the 5th year mark. So this bond is a 4.5% coupon, but it comes with a reset after the non-callable date of 5 years. So if on the event, if the 5th year they do not call back, this coupon will be reset at a rate of let me repeat. If the bond is not recalled on the 5th year, then the bond will be reset on the basis of 1 year SORA plus the initial spread of 1.492%. And the reset date for this bond is 7th of June, 2028, 1 year before the maturity date. So for HSBC, they do have a rating of A3, A- and A+ from Moody's, S&P, and Fitch. And for this bond, it's approximately 5.11 years till maturity. And the indicative pricing for this bond is at 100.728. And it gives off a yield of roughly around 4.33%. So benchmarking it against our SGS 2.625, that will be maturing on 1st of May 2028. The yield spread for this would be 126.93 basis points. So for HSBC, in their first quarter 2023, there were improvement in their net interest income. So their revenue has rose by 74% year on year, from USD 11.6 billion in first quarter 2022 to 20.2 billion in first quarter 2023. Their net interest income, NII, and net interest margin, NIM, remain stable. The NIM moved up by 1 basis point quarter on quarter to 169 basis point in first quarter 2023, while their NII dipped a little from USD 8.98 billion to 8.95 billion. In terms of HSBC credits position, they remain well positioned with their CET1 ratio improving from 14.2% in the previous quarter to 14.7% in their first quarter 2023. So 14.7%, it's within their targeted range for their FY 2023, because their targeted range for their CET1 ratio is to remain within the range of 14 to 15%. So they are quite close to the cap of their targeted range. In terms of their liquidity coverage ratio, HSBC has a LCR of 132%, which is way above the regulatory requirement of 100%. So we believe that this HSBC it's quite a good name, and it's offering quite a decent yield for the next coming 5 years. So for our strategy in this quarter, it will be accumulate bonds, as because for the federal fund, they expect for the rates to trend down starting next year and reaching its targeted range, like I've said earlier, of 2% after 2025. So I mean, because as right now we are in a high interest rate environment, and subsequently rates tends to dip down further in the years. This currently presents opportunities for investors to capture the bonds which are currently trading at a higher yield level before it starts to taper off in the later period of time. So secondly, it's also because why we mentioned about hospitality sector, because hospitality right now it's in a good position to capture the recovery in traveling. And I mean, this recovery, it's also starting to review itself within their financial results, like I've mentioned in the first two examples. So I mean, we are trying to create a strategy on around the recovery visibility of the hospitality sector, while also trying to snag in some bonds that have good financial records. So right now, I mean, because due to the high interest rate environment, a new issuance will have to be issued at a higher coupon rate. So I mean, usually when buyers are able to purchase this new issuance at the par value, this gives off a potential capital appreciation for this kind of bonds, because once it's traded in OTC, usually a few days later, they will tend to trade above par already. Yep. So this is my last slide, and this is just a rough snapshot on from Singapore Tourism Board. So this also helps to further bolster our speech on why tourism. So as you can see, back in 2019, when this is pre-COVID level, Singapore travelers arrival rate was hovering around an averaging of 1.4 to 1.5 million travelers per month. However, once COVID struck in 2020 to 2021, and only at 2022, earlier the first quarter, when Singapore border starts to reopen, then you start to see the pickup in travelers arrival rate. So I mean, as you can see at the far right of the chart, is you are able to see that travelers are definitely recovering, and I mean coming back into Singapore. However, they are not at pre-COVID level, but I mean they are showing significant improvement, and this further solidify the reason why we think that hospitality sector is attractive right now. Yep. So with that, I believe that's all of the info that I'll be sharing today, and we can move on to the question and answers. Thank you. Okay, first question from Kim Key. Is this the right time to buy good corporate bonds? And if so, what are your recommendations? So, like I mentioned earlier, right now for really, let's say, very strong names, such as FPL and let's say, so what FPL, Mapletree and etc. They are offering roughly around low. Their yields are offering rather low at around 4%, low 4% ish. So I mean, in terms of that, if let's say if we are really trying to lock in those coupons for a longer period of time, it's still viable. However, if let's say you're really looking for a short time horizon, then I think treasury bills are better, because right now treasury bills are giving off around 3.89% and may climb even higher in future windows. So yeah, I think currently it's still a good time to accumulate. I would say the word accumulate. Yeah, good corporate bonds if you are trying to lock in rates, because in the future, I mean, when rates starts to taper down, good corporate bonds, I mean, it's hard for good names to be issuing unsecured bonds at 4+%. Yeah, I hope that answers your question. Thank you. Okay. Please flash again bond idea 1 as missing it. Okay, sure. Okay. Okay. Jennifer, how do you buy bonds? Okay, so basically, how do you buy bonds? For corporate bonds, because they are traded over the counter, so you have to engage a broker such as Phillips Poems. Yeah, so you are able to engage a TR to place an order. So, but first of all, you have to create a Poems account. Then you engage your TR and you find a particular counter that you like, then you tell the ticker to the TR, then your TR will help to place an order with us. Then we are able to help you try to source the bond that you're looking for at the desired price to the best of our abilities, and we'll try to match it from there. Because bonds is traded over the counter as compared to stocks, whereas stocks is traded on the exchange. So you're able to see price changes instantaneously when the market opens. Whereas over the counter, it's more on a personal level, whereby we have to approach another counterparty to ask for the desired price that you're looking for. So if let's say you're looking at $100 and the person is able to match it at $100, then definitely we'll be able to make it for you. However, if you're looking at $98, but the person is only willing to let it go at $99, then we'll continue trying to source for it. Yep, I hope that answers your question. Okay, Sun Ho Fong. Are unsecured bonds safe to invest in? Well, I mean, unsecured bonds, yeah, most bonds are unsecured bonds, and apart from that, right, unsecured bonds are already ranked one of the highest in terms of repayment schedule. So in terms, let's say, usually the repayment hierarchy will be secured loans, which are usually bank loans that you lend from the bank. Then you pledge a collateral to it. Then secondly will be unsecured bonds. Then subsequently, when you move down the tier, then the repayment hierarchy would be perhaps even higher risk level, such as subordinated bonds. Then after that, the highest risk level would be additional tier 1 bonds or tier 2 bonds, and those are bank bonds and perpetuals. Yeah. So in terms of your question, are unsecured bonds safe to invest in? I would say that it's one of the, I would say, ranked the highest in terms of repayment schedule. Yeah. I hope that answers your question. Okay. Sorry. Let me take a look. Are there any bond tools like trading views we can track the cash flow in the future? In the future. Okay. Right now, okay, in terms of tracking the cash flows of the bonds, right now, okay, if you want to check, right, because when you buy the bonds itself, they will be clearly stated on the repayment schedule of each respective bonds they are purchasing. So let's say if it's semi-annual, there clearly states that on this specific dates, for example, 1st of January and 1st of June, you'll receive it annually. So, I mean, first of all, their prospectus will have already been stated clearly. Or secondly, if you have a Bloomberg terminal at home, or you're able to get a hands on a Bloomberg terminal, then you're able to type in the bond ticker and you're able to trace the bond cash flows lah. Yeah. I hope that's answered your question. Can you flash bond idea too? Yep, sure. Okay, Shireen Lee, is there a minimum value to buy? Yes, for corporate bonds, for SGD issuance, it's usually at $250,000 per bond. That's the minimum value to go into for a bond. However, if let's say if it's a retail bond such as Astro, Frasers, and etc. If I'm not mistaken, I think last time the previous one was Frasers 4.98. It was a retail bond. At that point of time, the minimum entry level for each particular bond would be 1,000 Sing. Yep, and this because it's a retail bond, it will also be reflected on the SGX itself. And for retail bonds, you're able to apply on the ATM as well. Yeah, only for corporate bonds with a denomination such as 250 for Sing dollar issuance or 200,000 for USD issuance. Yeah, this will have to go through a broker, yeah, in order to purchase it or sell it. Yeah, thanks, Shireen. Okay, let's see. So what do I want? Okay, from Jennifer. So if you want to monitor the prices of bonds, then do we always have to go through the TR to check it out for us? If not available online, like for stocks, as of now, would you recommend T-bills or bonds that you presented? Would you say the risk is about the same? Okay, so yes, because right now, because bonds are traded over the counter, unless if it's a retail bond, then you're able to look at the prices on SGX itself. If let's say if it's a corporate bond, then yes, there's a few options. It's either, first of all, you can go through a TR, or let's say if you have a POEMS account, then you'll be able to look at the indicative pricing because we have a bonds tab within our POEMS system. So you'll be able to look at the indicative pricing of the particular bond. However, do note that it's an indicative pricing for that day itself. So for example, if let's say Fraser's property, the indicative pricing for that maybe 3% bond, it's showing 98. But however, if let's say at a point of time you would like to make it, you would like to buy it at 98, it might not be 98 already because that is just an indicative pricing. And that pricing is only updated every morning at I think 10 a.m. or so. Yeah. So I mean, you have to try to put in I would say a value to see if that order transaction is able to go through or not. But in terms of checking the pricing for each bond, then yes, you will have to check with the TR or the system or the brokerage system itself. But all the quotations are just indicative and it's not final. Yeah. I hope that answers your. Oh, sorry. The second part is, as of now, would you recommend T-bills or bonds that you presented? So if you to realize that I think just now I've also mentioned that if let's say your investing time horizon is really, really very short, then definitely, because since rising interest rates environment, our T-bills is right now is offering a really attractive yield at almost close to 4%, because at last year, I think early December, our T-bills was offering around 4.4%. But that were the days lah, where it was at its record high. So I mean, for T-bills itself, right now I think it's at 3.89, and it might creep a little higher. So I mean, if your investing horizon is really short, then T-bills, I think it's a safe way to go, since it's almost considered risk-free lah, and it's guaranteed by the government. Yeah. And for the bonds that I've showed you earlier, I mean, I wouldn't say the risk is about the same, because these are corporate bonds. Definitely there will be risk involved, such as default risk. I wouldn't say T-bills there won't be any default, but the chances are much lesser. So I mean, that's why for every bond that I've shown, I've benchmarked it against our government securities. So this spread tells you that the amount of yield that you are earning for the risk level that you're taking. Yeah, so definitely the risk level for a government security and a corporate bond is different, and you have to know that. And I mean, different bonds have also different risk level. So I mean, right now I've mentioned about most of my bonds that I've mentioned are all senior unsecured, which is relatively on the safe, I would say, in terms of repayment hierarchy, is ranked at the top of the pyramid, rather than perpetuals where it's which is slightly lower lah. Yeah, then this will have a higher risk level. Yep, thank you. Are all these bonds, are all these three bonds all SG based? How do we know of bonds in other markets like USA? Aren't the coupon rates there higher? Maybe can get 8 to 10%. Or are there high coupons in Singapore? Yeah, definitely. For if you want to know more about US bonds, definitely our site are able to cater to US bonds as well. However, yeah, our poems are able to cater to US bonds. However, right now, we are strong in, we are, our bond desk is very strong in Sing dollars. However, I mean, if you are looking at USD bonds or other currency bonds, yeah, it's also available within our poems platform. Yep. To answer your question. Okay. My answer about, oh, sorry. Okay, let me see. Perps. How does wait? Tian Xiang Chun. Okay, let me check. Perps. Perps. Where are the perps? Sorry. there's too many questions I can't see. So yeah, I'll try to scroll through one by one. How to check rating of bond? Example, BB, CCC. Okay, so for bond credit ratings, it depends, because some bonds have a credit rating, have a credit score, but however, for most SGD bond issuers, they do not carry a credit rating. So for example, let's say Capital Land Escort Trust. Yeah, Capital Land Escort it's a SGD. However, it do have a credit score of BBB minus. Yeah, so some do, some do not. However, those that does have credit ratings, be prepared that their coupon rate or their yields might be lower, because there's some sort of validation in terms of the financials already. Yeah. So in terms of how to check that, you have to ask your TRs, or you have to look at the prospectus. Yeah, or you can look at the company's investor relations page to see if the company has a credit rating or not. Yeah, thank you. Okay. OCBC, your views on OCBC perpetual, please. OCBC, okay. Kim Ki, for your question, right now I do not have a view yet, but I can get back to you. So perhaps you would like to maybe drop me an email. I can flash out the email. Or you can join our community, bond community chat, and you can post the question there. Hold on. Yeah. So you can download our P3 app, and within the P3 app, right, there's a group function whereby you can sieve out from groups. You can go to the Phillips Bond Desk group, and you can post your question there. And once I have a view on it, I can get back to you. Yep. Thank you, Kim Ki. Your views on SGD 81 Cocoa. Yeah. Okay. So I mean, although like I said, for 81 bonds, right, their yields are very attractive. However, the risks that they're carrying are also very huge. So if you were to realize, just now I've mentioned most of them are senior unsecured. So in terms of risk level, it's way lesser than 81s. However, if you are unsure or if you're scared of 81s, are uncomfortable of 81s, then it would not be recommended because there's a chance whereby if let's say, there's a loss absorption clause that is being triggered, there will be a complete write-off of your bonds. Yeah. So before you do anything, then you should ask yourself if you're comfortable with this product before investing in it. Yeah. Yeah, CG Ting, what is your view on foreign banks like Barclays, BNP, AT1? Any negative reports? Yeah, so my view on AT1s are in general the same. If you're uncomfortable with it, then perhaps you should try to avoid it, unless if let's say you are really, really comfortable with the name itself. Then you can consider. However, because of the recent saga of AT1, then I would say less financial prudent investors will be more exposed to the risk of AT1s. Yep. Thank you. It's all CG take. Do you recommend to buy these AT1 bonds? The views is similar. So I hope that answers the question just now. When a corporate bond is launched, what are the chances for individual investors to succeed in their application, given that we are competing with institutions? So for this question, right? For this question, you'll have to check with your dealing team or or ask your dealing manager because you're being tagged to them. So the chances of you attaining the bond itself during launch, it's all based on them. And they are also able to advise you on the process on how the allocation works. I hope that answers the question. Okay, Sang Chun, Herb's question not answered above. Sorry, but Sang Chun, I don't see your question here. Perhaps you can email in the question, then I'll get back to you on a subsequent date. Thanks. I missed out on the earlier part of this webinar. Is it recorded, or may I get a copy of this slide? This webinar is recorded. In terms of the slides, we have to get clearance first before we are able to pass out the slides. So I mean, you can try to email in first, and once we get clearance, then we are able to send you the slides. Okay, I mean, so WYL, US bonds are subjected to 30% withholding tax for non-US citizens, not tax efficient. For us, we are not, we can't comment on tax issuance related issues. So we are not able to advise on this matter. So I hope that clarifies your part. Okay. The price quoted by Poems will be different from those of Fund Supermart. Quite right, because technically, yes, everyone got different price. Yeah. So regarding this question, right, the price. Yeah. So regarding the question on the price quoted by Poems will be different from those of Fund Supermart, right? Yes. The prices will differ because there's no centralized exchange. Hence, the information that we'll be getting from our counterparties and them getting from their counterparties will definitely differ. So I mean, it's like a shopping, essentially. Yeah. So basically, correct. So essentially, whatever you're saying, the prices on both platforms are just indicative and reference pricing only. So if let's say there's a particular specific price that you want to look at, then perhaps you can put the order in on your selected platforms. Then you'll be able to see if it goes through in other words. Yeah. Thank you. Yeah, sorry. I think in view of time, I think I'll get the last question because there's another webinar to go. I've missed the earlier part too. Will it be good if you can watch a replay on it? Yeah. Once we get our clearance from our compliance site and our Marcom site, and if they agreed to be put up onto YouTube, then yes, you can try to email in. Then once the video is up on YouTube, then we'll send you that link. Yeah. Thank you. Okay. So, okay, the last one. Do you see a rate hike in July? Yes, very likely because since Powell has mentioned that there will be 2 more rate hikes since Powell had mentioned that there's additional 2 more rate hikes this year. So most likely, right, they will try to push for the first one in the subsequent meeting in July. Then I believe they will try to monitor the current state of it and before they give further indication of whether there's further rate hikes in the subsequent meeting after July. Yeah. Okay. Thanks, everyone. Sorry I have to cut short this seminar. But yeah, if you have anything, you can feel free to email into Bond Desk to us. Okay. Thank you, everyone.